Hello and welcome to Any Answers Answered for July 2022. We'll be taking a break next month as it's the summer, but we'll be back in the autumn with more of your questions. However, we do have two for today. And we start with a question from, I think we can now say regular contributor, Tim. Jigs has asked a question, and quite reasonably, Jigs has claimed 100% capital allowances on an electric car. And the question is, the car is being sold. Is it now depooled, therefore creating a balancing charge, or can the proceeds be allocated to the general pool, which may just reduce the tax written down value carried forwards? What do we think, Tim?
Yeah, it would be a balancing charge, wouldn't it? As always with tax, it all depends. Now, over the many, many years that I've been lecturing all around the country, I've had essentially two different ways of dealing with a car used for my business. Initially, the car was used for the business of my partnership. And so the partnership, an unincorporated business, was entitled to claim capital allowances, but there was private use. And for many years, because of the nature of our business, the private use was only 10%, so 90% of the costs of the car could be claimed on the business. And for capital allowance purposes, if we're looking at sole traders or partners, then an asset such as a car that is part business, part private use is, as Jigs puts it, depooled. It goes into its own column or calculation, and the capital allowance is restricted accordingly. But that then means that on a disposal, there would indeed be a balancing charge, and that balancing charge, or the business percentage of it, not the private, that balancing charge would give, if we've had initial 100% relief, that balancing charge would claw back some of the tax relief given initially. But that's where we're looking at an unincorporated business. Now, it wasn't clear from the originally posted question as to the circumstances. And one of the posters asked, is it corporation or income? And is there any private use? And another said, private use is the answer, but it wasn't actually. We needed to find out. But the poster said, I've entered 1% private use on a car exactly for that purpose. That was in order to have it depooled, possibly in order to get a balancing allowance rather than triggering a balancing charge. But then the original poster, Jig, said, sorry, yes, corporation tax. And of course, the difference there is that if we're looking at corporation tax, there's no such concept of private use. And so the company is claiming capital allowances. And unless we're looking at a long life asset, which a car is not, it will be pooled and the normal rules will apply. So it will go into the general pool, get the 100% allowance, the proceeds when it's sold will be deducted from the tax written down value of the pool, so it could easily be covered by tax written down values of other assets in the company, and that will avoid the immediate balancing allowance. So that was the answer to that question, and different as it often is between unincorporated businesses and companies. Interesting, the suggestion that one of the posters made, who was it again? Paul Crowley, suggesting that you could perhaps specify a 1% private use in order to depool it.
And of course, the point I always make is that a company can't drive a car. And that is why, as soon as it's a corporate car, there cannot be private use. It just simply isn't possible.
Exactly right. So that's only if we're looking at sole traders and partners.
Yes, absolutely. Our second question this month comes from Doug Scott, who has a director of a company who is renting out a workshop to his company, or is he? As Doug says, at the present time, it would reduce the director's overall corporation tax, income tax burden to take a rent on the workshop, but the client isn't sure why he doesn't do this. They think the previous accountant had advised them not to because of potential future tax liabilities when he retires and sells the business. Tim, should they be deducting it now? And what future liabilities are we talking about?
Well, the first point I'd make is that when we're looking at owner-managed companies, the extraction of profit from the company tax efficiently is an important area. And there are, let's say, 4 ways in which a director shareholder might be in a position, certainly in a case like this, to extract profit from the company. We've got the traditional 2 of salary and dividend. A third one is if you have made a loan to your own company, you can take out interest. And a fourth one would be if you're allowing the company to occupy premises that you own personally, as here, you can take out rent. As far as interest is concerned, that can be very tax efficient because of the availability of the savings rate band. Depending on the amount of director's fees you take, you might have some of the savings rate band available and 0%. But even without that, you could have the personal savings allowance of 1,000 for basic rate taxpayers, 500 for higher rate taxpayers. So interest can be very tax efficient. Rent can be a little bit efficient, not quite so much, but of course the point about rent, tax deductible for the company, taxable on the director shareholder, but without any national insurance contributions. So it is more tax efficient than directors' fees that would be subject to NIC, or than dividends, which are not tax deductible. But there is a downside to charging your company rent. And that's, I'm sure, what the previous accountant had in mind, and indeed what 1 or 2 of the posters on this thread have drawn our attention to. Business asset disposal relief. If the taxpayer were eventually to sell their shares in the company and at the same or roughly the same time sell the workshop that they own personally, they would probably want to benefit from business asset disposal relief and have a gain taxed at only 10%. Now, the rules for disposal of an asset that you own personally but is used in your personal company, the business asset disposal relief rules treat that as an associated disposal. However, and this goes back to the old entrepreneurs relief introduced in 2008, the amount of the gain on the workshop disposal that qualifies for business asset disposal relief and hence potentially 10% tax rate instead of the 28, well, no, it would be 20%, wouldn't it, for a business premise like this. The rules restrict the amount available for that relief if rent is being charged. So if the taxpayer charged the company a full market rent, then there would be no business asset disposal relief at all. If the rent paid by the company was at half market rental rates, then half the gain would be eligible for BADR, but half not. So I'm sure that is the reason why the previous accountant had advised not to charge rent. There's then some discussion in the thread that follows as to whether business property relief for inheritance tax might be the issue. And I don't think so. But in a case like this, where the individual owns the asset personally and it's used in a company that they control, then the asset would qualify on death for 50% BPR, not 100%. It would only be the lower rate of BPR, 50%. The payment of rent is irrelevant in that situation. So it doesn't affect BPR, but it does affect entitlement to business asset disposal relief. And then there was discussion about whether some sort of deemed rent could be attributed by HMRC if the company were to meet some of the landlord's costs in connection with the property. So rather than paying rent itself, what if the company paid costs of repairing the property, electricity bills, etc.? And I don't think the revenue would treat that as deemed rent. I think one of the postings does say that, yeah, here it is by Tax Dragon, rent in relation to an asset includes any form of consideration given for the use of the asset, see section 169S of the TCJA. But I think it's agreed that payment of electricity, etc., wouldn't count as consideration for the use of the asset. Repairs, probably not. Tenant repairing leases are not unusual, and so on. So that's the answer, I think. The reason for the previous accountant's suggestion not to charge rent would certainly have been because of the effects, the adverse effect that would have on entrepreneurs or now business asset disposal relief.
It really does highlight the minefield of different aspects that we need to consider in this sort of area. But for once, we get to say that the former accountant seems to have got this one right. Quite often, it seems to be say blame the former accountant. This time, I think good advice from the former accountant, and we can all move on with that particular situation for that client. Hopefully useful to both questioners and also to everybody else. Do keep posting over the summer. Have a wonderful summer, and Tim and I will see you in September. Bye-bye.